Hello Mavericks, how's it going? This is Rob Reinhold, and we're here to compare strategies. Alright, now I know I talked about this in our last session where we compared the horizontal spread to the butterfly spread. Many times in my early trading life, I thought to myself, I'm going to create my own options combination. If I go in and I buy 2 of these calls, sell 3 of these calls over here, buy a put here, and then do whatever. I thought I was like making these new strategies. And then when I looked on the risk graph, it turned out I basically just created a bull call spread. A very complex, complicated bull call spread. So there is a lot of redundancy in options, especially when you start to get into some more exotic things to where you can usually do them with a much more simple strategy. So today we're going to be taking a look at the diagonal spread versus the broken wing butterfly. And we're going to talk about how it's similar and how it can also be quite different. So if we take a look here, we've got our butterflies: call butterfly, put butterfly, iron butterfly. Now we don't have the broken wing butterfly on these setup sheets. So if I was to go in and shade these and say, okay, well let's make these more correct, then basically I would be going in and saying, okay, with the green part, if it's a bullish strategy, the green part's going to get much more green here in this +1 area, and then it's going to get less green going forward. It's basically going to look like the diagonal call heat map here. So you can see it gets very green at about a +1, +2, and then it gets less green going forward. So when you're just comparing butterfly to the diagonal call put, maybe it doesn't look similar, but we're going to be looking at the broken wing butterfly, which tilts a butterfly one direction. As you can see, these are all theta plays. They benefit from a decline in theta. They benefit from a decline in time. The difference is volatility. That's where the difference is. One is long vol, one is short vol. So let's just take a look at the diagonal call spread strategy. So here we have, again, just an example of a diagonal call spread. We've got buy the 140 call, sell the 150 call. Here is your risk graph. So this is a basic diagonal call spread. It's looking for a +0 to a +2 outlook. It's going to have positive theta, and it's going to have a little bit of direction to it. It's going to have a little bit of delta. If we take a look at a side-by-side comparison of the broken wing butterfly. Now again, a true butterfly is going to be where you have the same amount of contracts on each side. So that's the easiest way to think of a broken wing butterfly is that you've got more contracts on one side or the other. So you've got the short option, and then you make up the difference on the edges. Another way to do a broken wing butterfly is to do unequal distances. For example, someone could do the 140, 150, 170 butterfly all at the butterfly ratios. They could buy 1 of the 140, sell 2 of the 150, and buy 1 of the 170. That's still going to make it a broken wing butterfly. It's going to change the risk graph a little bit. So we're going to be taking a look at just changing the ratios here. So this is a long 2, short 3, long 1 ratio butterfly. And you can see all we've done is we've pushed this side down and we've lifted this side up. Whenever we do a broken wing butterfly, we're basically just saying, hey, we'll take on more risk on one side and we'll push up this on the other side. So if we compare these two, if we look at these two side by side, you're going to see they kind of have a little bit of the same profile. And if we literally stack them up, one on top of the other, you can see that it's very, very similar. So looking just strictly at this risk graph here, you're going to see that the diagonal call strategy is superior in the risk part. So you can see here, if it goes down, this diagonal call spread strategy will actually be much better up to a certain point. And you can see that in these areas, it's going to be a little bit better. It's going to be a little bit better. So let's take a look at the advantages of each. So the diagonal call spread, the advantage is lower costs. You only have 2 options contracts. 2 options contracts make this whole thing cheaper to 1 less commission, or maybe even 2 less commissions if you're doing an iron butterfly. And you are having to navigate less spreads. So commissions and spreads are where the costs come in. This trade is long volatility. So if volatility goes up, this will benefit this trade. Now, I love the diagonal call spread. And it's funny because whenever people hear me say that, they always think to themselves, what? Like, come on, the bull call spread or the call ratio back spread, there's better strategies out there. The reason I love the diagonal call spreads is this last one, the ability to roll. I love the ability to roll these out. When I do diagonal call spreads, I now think of it as I'm test driving my long call for a week to see if I want to keep it. Just think about that. So if you buy a long call that's maybe a month out, you sell a short-term call that expires in 4 days. At the end of 4 days, I get to make another decision on that trade. So imagine that you got to get into a trade, and then 4 days later, you can kind of decide, hey, do I really want to be in this trade? How has it acted? How has the market reacted? How has the sector reacted? And so that's what I love. You buy a longer call, you sell an option that expires this Friday. This Friday, you got to reevaluate this trade. I love that about a diagonal call spread. Because if it's no good, I'm like, hey, you know what? I'm just going to dump this, and I'm going to go put this money somewhere else. If the trade acted really well, not too well. If it takes off and runs for me, then I'll close it all out with a okay profit. But if it looks like it's really going to do well, I can either roll that to a higher strike price for next week. So if I had like the $50, $60 diagonal, I could roll the 60 up to the 65 for next week, which now I've opened up my bullishness. I could even roll down. Let's say the stock didn't do as well as I thought. I could roll down to a lower strike and say, hey, you know what? Let me be less directional on this for the next 4 to 5 days. So it gives me this ability to roll, and I absolutely love this strategy. And the nice thing is, every so often you're going to get one where you say, you know what? I really like this just as a long call. Like, I love when a stock is just breaking out on a Friday. My short call expires and I just hold long calls, and the next week my symbol takes off and runs, another 5-10 points. Well, I got into it with a pretty dumb little risk graph, a diagonal call risk graph, but it turned into a long call that turned into a large gain. So I really do like the diagonal call spreads. So let's take a look at the butterfly spreads, comparing this with the diagonal. You're going to see that this has a worse profit area in some points. Some points it has a better one, but where it has a worse profit area is none of the areas you want it to have a better profit area. So we'll take a look at that on the charts, and you'll see that the better profit area is where it hangs out around the strike price. So when I get into my diagonal call spreads, I'm not looking to make a truly neutral trade. I'm making a bullish trade with some protection. That's what I'm doing on my diagonal call spreads. Hey, I'm going to make a bullish trade, but I'm going to put some hedging on it. So with the butterfly spread, you're going to do better if the direction doesn't happen. And that's really not why I put the trade on. If I want a truly neutral trade, I will put on a true butterfly. So for me, I don't really like that it's got, again, a worse profit area in the places that I'm looking for, and a better one in the place I'm really not looking for. Now this trade is going to be short volatility and no volatility if held until expiration. So the nice thing about butterflies is that you can just set it and forget it. You can max loss position size and just forget about it, and you don't have to make any decisions. I just told you how much I like to be able to make decisions on diagonals. those decisions can be good decisions or bad decisions. It's nice if you say, hey, trade is just one shot. I don't have to make any other decisions. I just am taking one shot on the direction I think is going to happen. So let's take a look. Let's take a look at a comparison here. So here is our broken wing butterfly. Now this is a General Electric 104, 107, 110 butterfly. This trade expires in 4 days. And the ratio is 8 to 10 to 2. So that's the ratio we put on this. You can see here the green is at expiration. It's at expiration. So this is our line. And you can see that max gain looks to be about $1,100. Max loss looks to be about $1,300. You can see at 110 and above, it's actually about a $500. Okay, so this is our broken wing butterfly. Let's compare this to our diagonal call spread. So diagonal call spread, we're long the October 15th 102 call, short the 107 calls. Remember, that was the same call we were short on the butterflies. Short the 107 calls. Profit on this one, $1,100. As you can see at 110, this is a profit about $700. And at 102, this has a loss of about $1,300. All right, now let's talk about this leg, because there's still some stuff going on down here. You can see that this is heading lower. We can see that this is like flattening out. So we don't really need to talk about what if it goes up to 115, 120, 130. We know that this is just going to flatten out at some point. However, this is going to take a while to flatten out. So if we take a look, this is probably going to go all the way down here. And what we can do is we can just take a look at our max loss. We're long the calls at 520. We're short at 81 cents. So that's basically $4.40 of risk. Times that by 7 contracts, and that's about $3,100. So this one does have more risk. There's no question about it that this has more absolute risk, all the way down to $3,100. So this is why when I teach diagonal calls, I always am very, very clear about that this leg, this bottom leg, has, I call it tail risk. So we need to do everything we possibly can in a diagonal spread before we even get in it to eliminate this tail risk. How can we do that? Well, we avoid earnings. We avoid periods of high volatility. We avoid highly volatile stocks. We're trying to find like some pretty boring trades. Like GE is a great example of a boring trade. We know GE is not going to run up to $150. It's going to go up a couple bucks, down a couple bucks. Now, as long as we avoid some pre-known events, we're going to be able to avoid much of this tail risk. Look, it's going to get you every now and then. You're going to just get some news that no one knew about. It just came out of the blue and hit. But remember, we're also going to be getting those runners where we start off in a diagonal. We let that short call expire. It takes off and runs. It's going to even out for sure on this. So if we take these two strategies, we lay them on top of each other, you can see that there is definitely some differences. So where the biggest difference is, and this again, why I like the diagonal better than the horizontal, better than the broken wing, is that I have a much better profit graph if my premise is correct. So if my premise is this thing's going to be bullish and this thing's going to run, you can see I've got a better risk graph. And frankly, I even have a better risk graph down here on the diagonal. Again, here's the butterfly, here's the diagonal. I've got a much wider profit area. That's what I like. I've got a wider profit area and I got a bigger profit area. And what am I giving up for that? I'm giving up this. I'm giving up this max risk. This thing's going to go down to about $3,100. So there's going to be a whole lots of stuff down here that I don't like. That's why I spend a lot of time trying to avoid this tail risk. Playing the right kind of stocks, avoiding diagonal call spreads in periods of high volatility in the market. All these ways to just eliminate this. So you can see on paper the diagonal looks like a better trade unless there's a big drop. And then the broken wing butterfly is going to take the cake. Alright, so you can see here we're not looking at a ton of difference. So let's say the stock goes up to 106. We're looking at a $350 gain compared to 510. At 107 we're basically at the same point. At 108, we're like 20 bucks apart. 109 we're maybe $100 apart. So there's not a lot of difference anywhere like above, I'm going to say 105.50. 105.50, these trades are very, very similar. Where they get different is, from 105 down to 102, the diagonal call spread is going to be superior. Going to have less of a loss. Below 102, the butterfly is clearly superior with the max risk. So really the difference between these two trades is volatility. So here is the broken wing butterfly spread effective volatility. So if you take a look up here, I've got 4 lines. Each of these is a $10 change of volatility. So this top line is going to be if volatility rises by 40%. It's going to be this purple line up here. This one down here is going to be at 0 if there's no change of volatility at all. So you can see that a volatility increase is going to help this trade. It's going to move this up to at 107. It's going to raise this up to maybe an extra $100 on the trade if we want to get out of it earlier. And you can see here as it goes down, let's say volatility drops, this is volatility dropping. So let's say the stock doesn't go anywhere, volatility drops. We're looking at maybe $150. Maybe. That's what we're looking at here. Let's take a look at the effect of volatility on diagonal spread. And now we're talking about significant movements. So an increase in volatility, a 40% increase in volatility at 106, that's going to profit $1,300. Now that's a big jump in volatility, but you can see it's a much bigger influence than what we saw from the diagonals. At 106, we basically had really no change. So really affects this, and this is because we aren't all in the same month. With the butterfly, we're all in the same month. Horizontals and diagonals, we've got a longer dated option and a shorter dated option. Now we're getting the differences between the moves in Vega. Volatility decrease, you could see just big effects across the board on diagonal spreads. So if you take a look at this, you say to yourself, okay, the trades are fairly similar. The difference is how they react in volatility. The question is, okay, which one is going to be better? Now, I told you I love the ability to roll, but let me bring up one other thing that is kind of superior in the diagonals. When a stock falls, it typically comes with a rise in volatility. Think about that. When a stock falls, it typically comes in a rise in volatility, which helps the trade. So let's say that the stock drops from 106 all the way down to 104, but volatility goes up 30%. We've muted where we would have been. This is where we would have been at 104. Now we've muted it quite a bit. We have less of a loss. So when it goes against you, volatility helps you. When it goes for you, you see volatility helps you. Now when stocks go up, you typically see a decrease in volatility. So it's what I want to look at over here. But you can see At 106 and higher, there's basically no effect of volatility on the trade. Even if volatility really drops, there's no effect at all here. I shouldn't say at all, but there's a very minor effect. However, if the symbol drops, it's likely going to come with a rise in volatility, which is ultimately going to be beneficial to that trade. So that's one of the things that when you talk about diagonal call spreads, you kind of get a little bit of a bonus as well. Hey, if you're wrong and it goes against you and volatility rises, you're just not going to lose as much as you even planned. Which is a nice little bonus. But when it goes for you, volatility doesn't really hurt you at that point. Now that's on diagonal call spreads. Let's think about diagonal put spreads, because this is where you really get your bang for the buck. Because on diagonal put spreads, now you get both. You get the price movement plus you get the bump up in volatility, which ultimately is a double help. You were short delta, the stock went down, volatility went up, you get a benefit on both delta and vega. So I do like diagonals on the point. I love them because they are a way to take a long call and slow it down short term. And that's the best way for me to put it. If you look at a long call, you've got all this delta, you've got all this theta, you've got all this vega, and you turn it into a diagonal for 4 to 5 days, and it mellows it all down to where now we don't have to be so reactive when price movement happens. We talked about the diagonal put spreads, and I think the best way to look at diagonals is the ability to roll, to say, hey, you know what, I want to get into this position for a couple of days, and then I want to make an ultimate decision on this long call down the road. So let's talk about when broken wing butterflies make sense. All right, for me, a broken wing butterfly is when you don't want to roll. When you say, hey, you know what, I don't want to roll. I think this thing is going to be sideways or slightly higher, and I just want to make a trade and forget it. I just want to make a trade, lock in max gain, lock in my points, and not make this too complex. If someone said that's the premise I'm making a broken wing butterfly trade under, I would say that makes total sense. I totally get it. Go right ahead. That looks great. Other than that, I don't really see a reason for many broken wing butterflies. I just don't. I think the diagonal call spread gives you way more options for sure. So that is the comparison. You can see they're very similar strategies. They work about the same way. Volatility is the one thing that comes in and says, okay, how should we handle this volatility? In my opinion, it's just my opinion, diagonal call spreads are superior for most traders. I think it just gives you a lot more options to do things. Where the broken wing butterflies is basically a one shot. I'm going to take one shot at this, and if it works, it doesn't. If it works, it does. Great, and then I'll just move on to the next one. That, to me, is how broken wing butterflies make sense. But if that's not what you're looking for in the trade, then I think diagonal call spreads are going to be far superior. Now, if that is what you're looking for in the trade, the broken wing butterfly is probably not even the right choice. There are other strategies that probably give you a better profile than the broken wing butterfly. And that's why I say it doesn't make a whole lot of sense. If your profile is, I want to make one trade, short term, and just set it and forget it, I like the vertical spreads better. They're more simple, they have better numbers, and you can make them. You can make a vertical spread theta neutral, you can make it theta positive. There's a lot of things you can do. So I just don't see a whole lot of reasons for broken wing butterflies most of the time. Hey, thanks for joining, everyone. Take care.